Charles Schwab announced about a week ago that they're going to be doing some massive ETF splits on some of the biggest ETFs in the game. SCHD, SCHG, SCHB, and SCHV are some of my favorites, and they're here on this list. They're even splitting their bond ETFs, small cap ETFs, and even the international ETF, SCHF. Of these, my all-time favorite is SCHD, which is the Schwab US Dividend Equity ETF, which has had a phenomenal track record as far as growing its dividend, but also in price appreciation each year. The total return on this ETF is up over 11% at almost 12%. This is just insane because that's the average per year over the last 10 years. And that's including 2022 when pretty much everything was down like 20%. To put this into perspective, if you were to invest just $500 per month for 30 years at this appreciation rate of about 12%, you'd end up with almost $1.5 million from just $500 per month. And then at that time, if the dividend rate stayed at what it's at for SCHD, which is right around 3.62%, you'd be able to live off the dividend, giving you over $54,000 per year in passive income forever. The fund would continue to grow each year as well, so you'd actually earn even more of a dividend every single year after that. All these reasons and more is why this fund is one of my favorite funds and one of the biggest holdings in my entire portfolio. But now that the ETF split is about to happen on October 10th this week, it makes it even more exciting. I've been getting asked this question over and over. Is it better for us to buy more shares before the split, or should we wait and buy more shares after the split? So I'm gonna answer that in this video, along with some data and research so that you can understand when the best time to buy will be, and I'm gonna explain how I'm investing in this fund and others moving forward for the rest of 2024. My name is Nolan Gouveia. My students call me Professor G, and I made this channel to make investing simplified. So when the split happens later on this week, it's gonna make each share price very, very inexpensive as far as total share price. Right now, SCHD is going for about $85 per share. And pretty soon it's gonna split 3 for 1. What this means is that now each share will become 1/3 of the price. So $85 divided by 3 equals $28.33. And real quick, for those of you that hold SCHD right now, say you have 100 shares at $85, that means you have $8,500 worth of SCHD. When the split happens, now you're gonna have 300 shares at $28.33, so 300 shares times 28.33 equals still $8,500. It didn't change your total amount that you own in it at all. You just now have more shares, but the shares are less price. This is obviously going to do something huge in the stock market. As far as dividend ETFs are concerned, this is going to be a game changer. But first, I want to thank and introduce the sponsor of this video, Moomoo. Moomoo is one of my favorite trading platforms, and Moomoo is actually going to give you 15 free stocks to get started on their platform and up to 8.1% APY for your cash. Unlike other apps, you can tap into pro-level tools and information for both beginners and advanced investors absolutely free. Now, I care most about keeping you guys safe, so I looked into Moomoo deeply, and Moomoo Financial Inc. is a member of the Securities Investor Protection Corporation, SIPC, which protects securities customers of its members up to $500,000. We're talking about investing in SCHD, and you can definitely do that through Moomoo. Moomoo also has no hidden fees, no minimum deposit required, or no account management fee. Plus, you can enjoy no commissions on stock, ETF, and options trading. If you're going to start investing and you don't know exactly which stocks to invest in, Moomoo can assist you with its easy-to-use tools, and I recommend you use the heat map and heat list to discover potential opportunities. Click the link down in my description, and you can get up to 15 free stocks by opening an account and depositing funds. So like I was saying, the fact that the price for SCHD is going to be closer to $28 rather than $85 is just going to make a world of difference for so many people. I know many people that don't invest in ETFs or stocks that are over $50 because sometimes it's tough to come up with that amount of money or that high of amount of money to be able to invest into. They'd rather buy shares of smaller amounts and just be able to have more within their portfolio. Think about it. If somebody wants to follow my 3 ETF portfolio and they want to do SCHD for dividends, VOO for the S&P 500, and then SCHG for growth. They need $85 for the SCHD share, about $520 for VOO, and then about $105 for SCHG currently. Since many people are already moving from VOO over to SPLG, since it's the same thing but cheaper, they both track the S&P 500, but SPLG is only in the high 60s rather than VOO being closer to $520. People look for cheaper alternatives to the Schwab accounts too, but now these are going to be $25 to $30 each, and so this is going to be a very good option for those new investors. Now some people will say, well, just buy fractional shares, so who cares what the actual price is? Well, that's great, but not all investing platforms have the capability to even buy fractional shares. So by Schwab decreasing the price for somebody to buy just one share of this fund, it's going to make it so that new investors, or even some investors that are just looking for less priced funds, are going to be able to buy these ones, or at least have it as an option for them. These are attractive prices, at least psychologically. Companies consider carrying out a stock split for several reasons. The first is psychology. Some investors may feel that the price is too high for them to buy as the price of a stock gets higher and higher, but small investors might feel that it's unaffordable. Splitting the stock brings the share price down to a more attractive level. The actual value of the company doesn't change, but the lower stock price may affect the way the stock is perceived, and this can entice new investors. So if you have some money to invest, should you be investing before the split or after the split? The ETF split is set to happen by October 10th and will be live as of October 11th. Now, a stock split increases the number of shares a company has, but it doesn't automatically make anyone any richer. There are some psychological reasons why companies split their stock, but the business fundamentals remain the same. However, the psychological value of a stock split can increase interest in the company's equity. Now, of course, this is the case for a company's stock split, and what we're talking about is the Schwab ETF stock split. Remember what an ETF is. An ETF is basically tracking the underlying assets, which are the companies within the actual fund. The underlying companies are what make the ETF more or less valuable. If the companies within the fund do better and they increase in share price, so does the entire ETF. And vice versa. If a bunch of them were to drop in share price, the ETF would drop as well. In this case, even though the ETF is going to be at a cheaper price, the underlying assets of the actual ETF haven't done anything as far as value. They haven't gone up or down based off of the fact that the ETF itself is cheaper. Like I was saying before, what this is going to do as far as them cutting down the price of the ETF is it's going to entice new investors or smaller investors to be able to invest in the funds. This is going to be good for overall liquidity and also for health of the actual Charles Schwab funds themselves. It's also going to help grow the price long term because it's going to give it more room for it to grow. One other thing that I keep getting asked about as far as this ETF split has to do with the dividend, and then also about one's cost basis. Actually, that's two things. Good job, Professor. Anyways, the cost basis is an easy one because you would just use the same exact ratio to figure that out. So if your cost basis on one share of SCHD is $60, which just means that that's what you bought it for. First of all, good job. You have some nice profit on that. Second though, once the share gets cut in thirds and now is $28.33, your cost basis is cut in thirds as well. So now instead of $60, it's $20. This is important for later on when you go to sell so that you're only taxed on the gain, which in this case would be $8.33 per share. As far as the dividend, it's the exact same answer. Percentage-wise, it's going to be the same. It'll still be about 3.6%. But the real answer is that if the dividend for this fund was something like $3 per share, and then the share is cut 3 to 1, then now moving forward, each share will produce a dividend of $1. Because that $3 dividend got cut from 3 to 1 as well. Basically, the idea is that everything gets cut 3 to 1, so everything will have that exact same 1/3 ratio moving forward. But as far as buying any more before or after the split, it's not going to make a world of difference when you decide to buy it. 5 years from now, I believe that this fund is going to be way higher than it is now. Whether they would have done this stock split or not, I believe that the value, the underlying value of the assets within the actual ETF will have gone up a bunch, because I do believe that value style companies are the things that are going to crush it over the next 5 years. And so I believe that SCHD is well poised to just gain like crazy. I do think that over this week and next week, there's going to be a lot of marketing and promotion from both Charles Schwab and then also people like myself or people who like to cover the stock market, showing that this is a pretty big deal. Usually ETFs don't go through these types of cuts, and so there's going to be a lot of talk and a lot of hype on this specifically. I do think that might drive price upwards a bit, so we'll see. What will make a huge difference for your net worth and for growing your portfolio is for you to be invested into great funds and for you to stay the course no matter what. Staying strong when others are panic selling or when the economy drops for a little bit, or if there's new shiny objects in this whole new AI sector or something and it's pulling people out of tried and true investments, that's the type of stuff that's gonna mess with your wealth. I believe that value and dividend style ETFs that are solid like SCHD are going to be the ones that actually win out over this next 3 to 5 years. And I just made a video on that, so watch this one next. Or if you've already watched that, then watch this one to keep you going strong in your investing journey.